Welcome in. Picture this. You're a restaurant operator in 2026, and your POS system is telling you that you absolutely crushed it last weekend. But when you check your bank account on Monday morning, disappointingly low. Sound familiar? You are not alone. Welcome to our deep dive into restaurant bookkeeping red flags and when to hire a controller. From 2023 through 2026, restaurants have been squeezed from every direction. Higher food costs, labor pressure, delivery commissions, card processing fees, all compressing already razor-thin margins. That means small bookkeeping errors don't stay small for long. They become payroll stress, vendor disputes, tax surprises, and mystery losses overnight. Today we're following the financial trail, why restaurant controls matter more than ever, what red flags to watch when a bookkeeper is no longer enough, and how a controller can transform messy numbers into decisions that actually run your business. Let's set the stage. Here is the hook that should grab every restaurant operator's attention. In a restaurant, strong sales do not automatically mean strong cash, and understanding three critical mental models can change everything. First, sales do not equal deposits, because tips, taxes, card processing fees, third-party delivery payouts, refunds, and chargebacks all take their bite before the money ever reaches your bank account. Second, purchases do not equal your cost of goods sold, because inventory timing and what is actually on the shelf matters. Third, profit does not equal cash flow, because payroll, vendor bills, rent, and fees leave on their own schedules. So when a manager says, "We crushed the weekend, but the bank balance looks terrible," that is not just bad luck. That is a signal the restaurant may be steering with incomplete and dangerously unreliable numbers. With the National Restaurant Association flagging relentless cost inflation as the defining challenge of 2026, the old strategy of just eyeballing it is a recipe for disaster. But if the warning signs are so visible, why do so many operators miss them until the damage is already done? This brings us to the crucial gap in how many operations handle their finances. A bookkeeper is excellent at recording and reconciling daily transactions, and that work is genuinely important. But here's where it falls short. Bookkeepers typically post and reconcile, but they do not design workflows, integrations, or the guardrails that turn raw data into reliable decisions. They aren't accountable for diagnosing margin leaks, explaining budget versus actuals, or building operational controls. The red flags appear fast. Late month-end closes, unreconciled bank accounts full of old unexplained items, gross margins dropping without any menu changes, negative cash despite sales that look fine, inventory shrinking from portioning problems or theft, recurring payroll errors, and sales tax becoming a fire drill. When these problems stack up, and they have been stacking up since 2023, you have hit the limits of transactional bookkeeping. You're left with accurate history, but no actionable intelligence. You are essentially driving your restaurant blind into a storm. Here is how we change that. Now for the solution, and this is where the paradigm shifts entirely. You don't just need someone to reconcile the past, you need a system builder, a controller, whether full-time for a multi-unit operation or fractional for a single location, doesn't just record your financial history. They build a financial fortress around your entire operation. Unlike a bookkeeper who focuses on daily tasks and month-end tidy-up, a controller owns the complete financial system and control environment. Their deliverables include a close calendar, a chart of accounts cleanup, budget versus actual analysis, POS to accounting integration, and a game-changing 13-week rolling cash forecast. Their reporting cadence is completely different. Weekly flash reports, fast month-end closes, and monthly management packages that steer actions and prevent leakage. They design the workflow so numbers become decision-ready and repeatable. They implement variance reporting to catch waste and theft, and they create dashboards where KPIs become your tripwires. This is the paradigm shift, from reactive data entry to proactive financial management. Let's look at exactly what this methodology reveals when you put it to work. When you implement a controller-minded approach, the findings are immediate and eye-opening, and you can run a rapid 7-day diagnostic to expose exactly where your numbers are drifting. The first test is your POS to cash reconciliation. Pick any 7 days, Compare what your POS says you should have deposited versus what actually hit your bank, and log every single variance with a reason. The second test is your top 20 vendor sanity check. Match invoices to receiving records, confirm pricing, and hunt for duplicates and missing credits. Third, compare scheduled hours to paid hours to catch overtime surprises, unauthorized manager edits, and scheduling manipulation. Fourth, pick 10 high-dollar inventory items, steaks, spirits, seafood, specialty ingredients, and compare theoretical usage to actual depletion to expose portioning problems, waste, or theft. These 4 simple tests produce a fast map of where deposits, invoices, hours, or inventory are drifting off your books. Critically, they also separate a genuine profit problem from a cash timing problem, 2 very different diagnoses that require very different responses. Most restaurants suffering the cost squeeze of 2023 through 2026 have multiple active leaks in these exact areas. Let's talk about what to do with what you find. Knowing your leaks is not enough. You need both the right person and the right structured plan. So let's clarify the hiring decision first. A bookkeeper records and reconciles accurate history. A controller designs the financial system, the reporting rhythm, and the internal controls that make numbers useful for running the business. A CFO focuses on strategy, capital, and long-term growth. The tipping points for hiring a controller are clear: recurring cash surprises, repeated penalties, messy delivery app reconciliation, a month-end close that arrives too late to influence decisions, lender or partner reporting requirements, or expansion to multiple units. A full-time controller fits multi-unit complexity. A fractional controller works well for a single location that needs structure and weekly oversight. Once you have that person in place, here is the proven action plan. In the first 30 days, act like an emergency room doctor. Audit bank reconciliations, clear undeposited funds, match POS batches to deposits, review duplicate invoices, and track 5 weekly flash KPIs every Monday: sales, prime cost, labor percentage, food cost percentage, and cash runway. By day 60, build the rhythm. Install a close calendar with real deadlines, tighten inventory through weekly counts and receiving controls, and implement schedule approvals and overtime rules. By day 90, optimize and forecast. Build a rolling 13-week cash forecast. Add budget versus actual reviews, and use contribution margin analysis to sharpen pricing and menu decisions. The resolution to these bookkeeping red flags is a fundamental paradigm shift from reactive, backward-looking bookkeeping to predictive, forward-driving financial control. In 2026, the restaurants that are winning are not just recording what happened. They are using integrated POS to accounting systems that cut manual entry and compress month-end closes from weeks to days. They are deploying anomaly detection that flags suspicious voids, comps, and refunds before they become confirmed theft. They are running weekly flash reports that turn KPIs into immediate actions. They are maintaining strict permission levels so no single employee can manipulate cash, comps, or hours without a visible audit trail. They are conducting surprise inventory checks that keep the entire team accountable. The old model was eyeballing it and hoping for the best. The new model is no surprises reporting, where you see problems forming and prevent them before they become crises. The restaurants that survive and grow through the 2023 to 2026 margin squeeze are the ones that made this shift, from hoping their numbers work out to knowing exactly how their business performs every single week. So let's bring the story home. If your restaurant's numbers feel mysterious, the problem is almost never just sales. It is visibility and control. Late month-end closes, unreconciled bank activity, shrinking margins, inventory variance, payroll errors, and recurring cash surprises are the loudest signals that your bookkeeping process is breaking under today's relentless cost pressure. The fix is part discipline, daily reconciliation, documented procedures, segregation of duties, inventory counts, and clean approval rules. But it is also leadership. Someone has to interpret the numbers, explain the variance, and turn KPIs into action. That is where a controller, full-time or fractional, earns their keep many times over. The restaurants that will thrive in 2026 and beyond are the ones that take 5 actions this week. Reconcile your cash to POS and deposits daily. Clear your undeposited funds. review comps and voids, count your highest dollar inventory items, and start even a rough first draft of a 13-week cash forecast. Stop steering your restaurant while wearing a blindfold. Hire a controller. Implement these diagnostics and transform your financial chaos into controlled, predictable growth. Your margins are too thin for anything less. The sooner you act, the cheaper the recovery and the stronger your path to growth. Like and subscribe for more helpful videos like this. Connect with Forks for the experienced accounting professionals your restaurant needs. Details in description below.